For episode 20, my guest is Alex Morris, the founder of TSOH Investment Research and the author of the newly released book, Buffett and Munger Unscripted. Before starting his own firm, Alex spent a decade as a buy-side analyst. He earned his undergraduate degree and MBA from the University of Florida and is a CFA Charterholder. We sat down to talk about his new book, which pulls together decades of insights from Warren Buffett and Charlie Munger, organized by topic across everything from investing in business operations to decision-making, leadership, and so much more. A lot of what's in this book goes beyond business and investing. It applies to how you think, work, and live. We each talk about what drew us to their work and different themes Alex uncovered while he was writing it. Now, I've followed Buffett and Munger throughout my career, not just because they're insanely good returns, but because of how clearly and authentically they communicate. While they mostly stuck to an approach that worked for them, they also never stopped learning and evolving, even after realizing massive success. Alex and I also talk about how their thinking has shaped his investment approach, what it was like taking the leap to start his own firm, and why many of their core lessons are closely related to our foundations of investing. We also talked about common misconceptions. These guys are not just two old, rich stock pickers with some clever quotes and Midwestern charm. They are two of the best strategic thinkers of our time, whose insights can help us filter out the noise and stay focused on what matters on a time when that is harder to do than ever. Now, whether you're a longtime follower of Warren and Charlie or just curious to learn more, this conversation is packed with practical wisdom. In a world increasingly focused on the short term, the lessons in this book offer a real edge, whether it be in investing, business, your career, or life in general. And with the 2025 Berkshire Hathaway meeting coming up, the timing couldn't be better. So big thanks to Alex for joining us, and we hope you enjoyed this episode. So for today's episode of Inflection Points, I am sitting here with Alex Morris. Alex is the author of the recently published book, Buffett and Munger Unscripted. He is also the founder of TSOH Investment Research. So, Alex, there's a bunch we want to talk about today for listeners and frankly for myself after getting through the book over the last few weeks. Maybe just to start, for listeners, how would you characterize the book itself?
Yeah, well, first of all, thank you for having me. I would characterize the book as effectively a broad resource that covers a number of topics related to things about business and investing, and with the source of that content, by the way, being Warren Buffett and Charlie Munger, probably the two people on a very short list that you'd want to be supplying the information about business and investing. And just to give a short backstory, my introduction as a young investor really started with Warren Buffett's shareholder letters, and there was a book that I stumbled upon in, call it, the mid-2000s, called The Essays of Warren Buffett by Larry Cunningham. And it's a very similar structure in terms of taking, at that point, a couple decades of shareholder letters and organizing it around topics like capital allocation and management and, business quality, et cetera. So really just taking the kind of ingredients that lead to thinking about business and investing, and just like framing how Warren Buffett and Charlie Munger think about it, I guess. And that's in that instance, more so Buffett, because they were his letters.
Yeah.
So that was a book that meant a ton to me in the mid 2000s. So, fast forward 20 years now, and I basically created something that I view as pretty similar, but the source material is, these 30 plus years of shareholder meetings.
Yeah. It was interesting. Like, as I was reading it, there were certain years that really stuck out. Like 94 stuck out. 08, probably for obvious reasons, really stuck out. There's a lot of 2017. And so there was a bunch more, but those years depend, and maybe it was topic dependent, but I saw it going back to those meetings. Any patterns you found there as you went through it, or anything surprised you in that way?
Yeah, 94 is probably a bit of a cheat year because that's the first year that they had for the videos. So as I was compiling the book, I was probably like, I need a lot of answers. I got to compile this book. And then as I got to the later years, I was like, holy crap, I have too many answers. I need to make this book shorter. So maybe 94 gets a special shout out in that regard. There was certainly a period during the late 90s where the discussions around, technology companies and things like that, there was a lot of interesting discussions around that, around pharmaceutical companies as well, which I wasn't, I was like 7 or 8 years old at that point in time. So I wasn't investing and I didn't know what was going on, but that was a recurring topic of discussion as well. And the nature of those questions really allowed Warren and Charlie to talk about things in a way that was really insightful. I mean, obviously, they generally talk more broadly from a pointed question, but it allowed them to share their insights in a way that was, really insightful. So that period really stuck out. There's the period around the 2000s with stock option accounting that allowed them to talk about something that doesn't really come up as much because it's a bit, arcane and people don't really necessarily understand it, right? So it's not something they're going to spend a ton of time on, but something like that. So yeah, there's certain distinct periods where there are really interesting topics that kind of come up over a period of years over and over. And
to your point, they end up in hindsight really capturing those moments in history, and usually not for the better. It's like the nonsense du jour that's being spouted and why it's not necessary or maybe why it's overdone, et cetera. It was really refreshing to see it in this order for me, because it just like you can second guess an approach in different moments in time, especially when over the last, call it 4 or 5 years post COVID, like there's been a lot of quote unquote easy money, right? And so going back and seeing that these patterns, like they've happened over and over and over again, and sticking to an approach that works for you is useful. But then seeing that these guys really, it's not a bunch of quotes and cliches on the wall, which is I think how they get pictured. It's practiced philosophy and wisdom that compounded over a period of years.
I was about to say wisdom, and then across an insanely impressive breadth of topics. I mean, again, like the stock option accounting thing for me is a really notable example because you can think of it as something maybe that's batted around in the news or people hear about in a lot of cases don't really deeply understand. And they have a way of getting to the heart of a topic like this and discussing it in a way that makes it so clear that really anybody can grasp it. I mean, the notable example on stock option accounting is if these aren't expenses, what are they? And if expenses don't belong in an income statement, where do they belong? And then pointing to something like when companies were given the choice for how to elect to account for stock options, 498 out of 500 companies in the S&P 500 went against the way that's actually accurate or correct. And just the way they frame a discussion like that, right? Even if you've been hearing about that for years and didn't really grasp it, they say it in a way where you can go, okay, now I get what's going on. And again, they can do that across, Warren's done it many times across, for example, in the utilities business and talking about basically privatized utilities versus more public utilities and talking about the puts and takes of having stakeholders requiring a return versus, there's just many different ways that they've talked about these things that is, again, really, really insightful for even people who are pretty well versed on business and investing.
And maybe especially so because you tend to get lost in the weeds of, or you're thinking how smart you are, and you don't see those blind spots that become obvious, like we said, oftentimes in hindsight. So, but
back to the first question. That's also where the book shines, in my opinion. As someone who compiled it, I still go back to it and I read things and I go, it basically still feels new to me. I mean, partly that's the length of the book, but there's so much about the letters and the meetings that is dependent upon your point of the journey. I think they're ahead of, I'm going to say, 99.9% of us in terms of their understanding about a lot of things. And, people say the meetings are like going to church, right? It's like you're hearing the same thing over and over again, but you're there's something about it that's really special and you're learning something. And I think that's the perfect description for the meetings and also how the book can kind of be consumed.
Yeah. And will you be in Omaha this year?
I will be. Unfortunately, Warren announced in the shareholder letter, they're doing one book again. They used to do the bookworm event downstairs where they would have 20 or 30 books and the authors would be there. But last year they did one book about Charlie, and this year they're doing one book about Berkshire. But I have found out the day after the Berkshire Hathaway meeting, Markel, an insurance company, has an event across the street, a brunch, and I'll be there signing books. So
all right,
I'll have a reason to be there.
So stepping back from the book, and we're going to dive fully in, because I think, something that that spoke to me in seeing this book, listening to you speak in other forums, was just like, I have found Buffett and Munger so useful to my life, never mind just my investment piece of the job that I do during the day. Right. And how I've approached my career, how I've approached relationships. Like it truly is, an across the board use case. And so what I want people to do who aren't nerding out on, annual meetings and, old archives of transcripts and things like that, is to just get a feel for who these guys really are outside of the, he's the rich billionaire, white dude, and he's, whatever he's talking about in the moment. Like it can kind of get turned either way politically too. But before all of that, which is super important, I want listeners to understand who Alex Morris is and how this came to be. So tell me a little bit about your career path and what led you to founding TSOH, your research firm.
Well, as I said before, I stumbled across the Berkshire letters in, call it, the mid 2000s, which is around, I went to college in 2007, the University of Florida. When I got there, I didn't really have a strong sense for what I was going to do. My dad's a plumber, and I decided to start off in building construction, which I did for, I believe, a year or two. I had to take a physics class at one point, which was, my dad's a smart guy, but I'm not smart enough for physics. I don't think. And I didn't realize that was part of being in the building construction or plumbing profession. So that started my path out of building construction. But yeah, I stumbled across the letters, and, it's kind of to the point of what you just said. The letters and Warren and Charlie generally, if it was just all like, here's how you make a bunch of money and get rich, and that was the whole thing, like it wouldn't be nearly as interesting. They wouldn't be nearly as popular as they are, I don't think. I certainly wouldn't have written this book if that's like all it was. Mm-hmm. What makes them so interesting is a broader understanding of the world and thinking about what business is, and thinking about, the role of capitalism and so many other things like along these lines that are just part of understanding the world, right? And understanding incentives and rationality and things like that. So, I was drawn to that as I guess I was a young man at that point still. And that started a path for me in terms of finance business. That said, going to the University of Florida and just having an undergrad degree, when it came time to try to find a job, mutual funds and hedge funds and the like were not chomping at the bit to hire me. So I had started writing around that time as well as a way to try to bolster my resume. I was making like $10 an article writing for Guru Focus, which at the time I was like, this is the greatest thing ever.
Yeah.
I made it. So I started doing that. I got a job in the industry shortly after at a small RIA, and and finance firms, generally speaking, tend to be pretty cautious in terms of anything that could be viewed as like a regulatory issue, talking about stocks.
I can relate.
Like
I can relate.
Yes. So that's when I started writing under a pseudonym. The pseudonym I chose was The Science of Hitting, which is a reference to a Ted Williams book on the topic that Warren Buffett has discussed previously, where you basically break down the strike zone for a batter in a baseball game. And there's certain spots in the strike zone, kind of your sweet spot, where you're going to bat 400, where you're going to be Hall of Fame, one of the greatest hitters ever. And there's certain spots in the strike zone where you're going to bat 220 and you're going to be, fighting to stay in the major leagues, basically. And Warren Buffett's twist on, the science of hitting, or that idea is, in investing, there's no called strikes, and you can kind of wait for a pitch that's in your sweet spot before you do anything. That kind of informed.
I use that all the time with clients, but it's not only investing. Like, so with younger clients looking for houses, like, it's been a crazy few years, right? It's stressful. Like, there's so many variables that go into it. Am I overpaying? Like, what's the rate versus what it was just a couple of years ago? Long story short, though, is I use that analogy of like you can keep the bat on your shoulder for as long as you're comfortable with it on your shoulder. And that's a hard thing. It goes against every instinct we have, whether it's buying a home, whether it's an investment opportunity, whether it's a new job, if you're looking for a new job. So I think that thought process, that framework really goes a long way to allowing people to, see what comes to them, versus maybe forcing it a little bit, and, swinging at that pitch in the dirt, or, outside of your expertise.
Right. Absolutely. And like so many things in investing, you have this black-white range of kind of perspective or ideas, and there's areas in the gray that, kind of hint at the reality of what kind of you have to do in order to be effective over time. And it's a really insightful thing in terms of being really thoughtful about opportunity costs, and, then layering on from there. To the extent you're going to wait 1, 2, 3, 5 years before you make a decision, well, then they can't be little decisions. They have to be meaningful decisions, because there's not enough of them for you to be lighthearted in terms of how you approach those. So anyway, so these things all feed on each other in terms of how my kind of investment philosophy evolved, and that was a name that I felt was really applicable to who I was. And fast forward over time, I worked in the RIA business as an equities analyst for roughly a decade. And I kept writing under a pseudonym throughout this time. As we get to, call it 2020, 2021, I looked around and saw some other people online who were effectively, sharing research, for lack of a better term, not necessarily all investment research, but like Ben Thompson at Stratechery, Scuttle Blurb in the investment space. I saw people who were doing something kind of similar to what I was doing, but they were going to people directly and saying, hey, subscribe to my work, and obviously I'll give you an understanding of what the output's going to be, but subscribe directly to what I'm doing. And I thought that was interesting, and it was something I wanted to try. So in April of 2021, I launched my investment research service, TSOH Investment Research. And I kind of told myself, I give myself a year or 18 months to see if I can do something here. And if not, I will, I'll try to go find another job as an equities analyst. So here we are in almost 4 years after the launch, and it's still kind of going strong. So it's been an interesting journey. I surely didn't know that I was going to end up here when I wrote that surely first terrible article, call it 15 years ago now, something like that.
Talk about how the writing helped guide the path a little bit. So, I mean, for most people in their early 20s to have the guts to say, I'm going to go and write, whether it's for free or for $10 an article, but no, I really love this stuff, and I'm gonna put myself out there. Like, that's a really tough thing to do. It's something I struggle with, writing my own little newsletter every week. And you're always, there's always that doubt when you're working on it, when you hit send and put it out there. So talk about how that guided you to where you are to a certain degree. Right? And maybe it didn't, but I'd assume it played a pretty big role when you're doing it for that long.
No, it certainly did. Maybe I was a little bit foolish or over.
Sometimes that helps, though.
Over considered my own abilities at the start. I mean, I'm sure in hindsight they were, I had room for improvement, to say the least. But I also I've always kind of approached things like that, and even investing generally, right? Like I wrote about this in one of my more recent kind of quarterly updates. This idea of, when do you start judging whether or not you're good or bad investor, for lack of better terms, which, by the way, is not something that necessarily translates so clearly to so many other professions. There's something about this game in particular where, to the extent that you want to measure it in purely numbers, you can go do that, and you can do it. You can measure yourself today versus the market, or you can measure yourself over the next week. But that idea of when is it actually appropriate for that to start? And as I think about my own journey, who I was 15 years ago as an investor, and certainly the level of thought behind my decisions, is very different than who I was 10 years ago, 5 years ago, and who I am today. And, it has to start at some point, but also I think you need to give yourself the leash to grow and to continue learning and to, let that process kind of happen. And again, it's a really weird thing because I don't think doesn't translate as clearly to so many other professions. And obviously you can find people who are, savants, for lack of a better term, like since they were 10 or 15 years old, they've always had great investment ideas. Yeah. My sense is, from the people I know, even people who are really good investors, my sense is that that's not always the case. A lot of people had to stumble and kind of fail at certain things before they eventually got into a groove of an investment approach that kind of really works for them. So I don't know. I've always just been of the mindset, just keep your head down and try to do the best work you're capable of today and get better. And over time, that should lead you to a better place than where you are now. But, to the extent that Warren Buffett was Warren Buffett because he was born Warren Buffett as opposed to hard work or other things, like, I don't know if I have that. I'm highly doubtful that I do, but I know I can control the input. So I'll just do the best I can on that part and see where it takes me.
But I think, though, like, one thing I've found or tried to come around to the idea of is it's really important to know yourself and what being aligned with who you are and what your style is. When I started kind of finding that for myself, things started happening outside of my day-to-day process because I wasn't trying to be who I wasn't, or I wasn't trying to apply a style that didn't fit. I came up on trading desks, on the commodities desk and the foreign exchange desk, and it was a great place to learn, but that was not going to be my path when I was sitting there at 45. And I sort of knew that instinctually for whatever reason. And I think, not to give myself credit for it, but I think just acknowledging this isn't for me allows you to get to that strong suit faster.
Yeah, absolutely. And again, I think it's, I'll frame it in terms of an investment philosophy, but it gets to what I was saying before, right? In terms of, if you're going to be someone who's going to sit and wait for fat pitches, there's certain beliefs or ways of approaching investments, as you're saying, that may align with who you are and that feel like the, quote unquote, right way to do things, that then have tag on kind of requirements in terms of how you then act going forward. An example for me is, I think I have a natural disposition towards wanting to kind of own things and partner with people, which then kind of lends itself to this idea of you can't be, especially to the extent that you struggle to find a ton of opportunities that pass certain filters, which I think is generally true. It's hard to find companies that you think are really, really well run, where you really, really trust the management team. And then if you layer on some sort of even loose valuation constraints, it's not that easy to find a ton of them.
Yeah.
So to the extent that you do find some, you have a constraint in terms of, okay, this stock's up 5, 10, 20%. Some people operate from the mindset that when that happens, the thing has worked and now it's time to sell and find the next thing, which is fine, right? That can be their approach and maybe it works very well. My point is if you have that constraint on the front end, you'd be really thoughtful about how you then act on the back end to ensure that, and this has happened, I think, to me to some extent in earlier parts of my career, you don't want to get 2-3 years down the road and you're like, oh, wait a second, because of these actions I took along the way, I'm now doing a bunch of things that really aren't even aligned with where I was trying to go or what I was trying to do. And there's trade-offs with all these things along the way, of course, but I think you have to be really thoughtful about that stuff. And to the extent that applies in kind of the investment arena. I think it also really applies in the professional career or even kind of like life arena in terms of, again, like trade-offs, opportunity costs. What are you kind of willing to give up or not do in order to get to where you want to go?
What was there a moment where you said, I want to do my own thing, I want to own it, and I'm going to jump? Or was it like a gradual progression, writing, doing research, talking to people, following people, where it became almost the obvious thing where like, I have to do this?
It was more gradual. I think and my views on this have evolved, and maybe the more correct term is matured over time. And there's a wide variety of investment advisors out there. And the people I work for, I think, were good investment advisors and did good jobs for their clients. But a lot of the investment advisory business can lean more towards the financial planning part of the business and asset allocation, and really the core tenets of being a sensible investor, which is incredibly important, by the way. And some people definitely need a financial advisor to help with these things, and they're getting good value for their money. The problem for me was my interest in a lot of this wasn't as much that as it was the stock selection and the individual research of companies. And for better or worse, probably for better, honestly, the firm that I worked for, that wasn't as much their focus. They had a view of how they wanted to run the business and what they viewed as adding value for clients. And it wasn't as much, me coming in and saying, I really think XYZ should be 5% of our clients' portfolio. That just wasn't the mindset. So, maybe wrongly, I kind of looked around and thought, okay, more places will probably be like this than not. And I should just go out and do what I want to do to the extent that I think I can find a market for it and find people who are willing to pay for my research, as opposed to kind of hitting my head against the wall a little bit and trying to, change the mindset and the incentives of people who are doing very well for themselves and their clients, by the way. Like this is probably a losing fight. So it just reached a point where I thought I need to at least give this a shot. And if it doesn't work, then, again, I can kind of pick up and go from there, and it'll have been a good experience, and I'm sure I'll learn some things along the way. But I need to give this a shot. And, it helped that I'd been doing it for over a decade at that point. I'd built up a reasonably decent following on social media and other places. Like I went into it thinking I should have a reasonable chance at this working. So it wasn't like I just, did it out of the dark one day or something.
Right. And you're doing something where that's the skill set that's going to take you back to the more traditional route anyway, fairly easily. You're not burning the boats in terms of your employability in the future, right?
Right. Yeah, I wasn't going to become a baker or something.
Yeah. So what were the biggest challenges in the first few years of taking that leap? You're still a pretty young guy in your career, although well experienced to your as you mentioned. So what were some of those challenges in the first 12 to 24 months that you had to work through, maybe using some of these principles?
Yeah, I mean, from a business perspective, I learned about kind of marketing yourself and getting your name out there, and I think, for myself and a lot of people like me, I think you feel really kind of awkward, like going out there and pushing your thing to people. You feel so promotional.
It's the worst.
But you have, like, people don't know who you are, or they don't care, or both. And you have to kind of hit people over the head a little bit to at least give yourself a shot of getting your name out there and getting in front of the right people at the right time. So that's certainly been a muscle I had to learn that I still need to kind of improve upon.
We struggle.
Part of it gets to,
we all struggle with that so much, and like to the point where we make fun of ourselves. I get myself to do it to a certain extent, but when you look around at what other people in the same industry can do and be fine with it, it's just never not going to be hard for at least for me.
Exactly. Yeah. Which I think, again, like I think part of it's been a learning curve on that in terms of like, okay, how do I do this in a way that's true to who I am and what I'm doing?
Yep.
And how do I, to the extent that there's a perception or reality in this industry that there are people who are doing things that I think are untoward. How do I then kind of counter position to that and make it very clear, like what I'm doing is very different than that. So to the extent, some extent, it's an opportunity over time in terms of branding and how I kind of frame who I am and what I'm doing. The other thing about it that's been difficult, I guess what I was saying before, is I'm transparent about all the research I do and then all my portfolio decisions and the returns. So to the extent that there's periods where the returns are not great, or at least on a relative basis aren't great to a market that's been running higher and higher and higher, at least until recently, that's difficult. It's a difficult conversation to kind of have with subscribers or people reading my research. And, but it is also the reality of doing this. And by the way, it gets back to partly why people don't necessarily want to go down this road.
Yeah.
Because there's a lot of times you're on the wrong side of that coin and it's not particularly enjoyable. It's also not that enjoyable to have to say to people, I'm doing the best I can. I have reasons to believe that I'm going to be successful at this over time, but I don't know that for sure. Nobody does.
Yeah.
So,
being comfortable enough to say that, talk about a differentiator in our industry.
Yeah. So hopefully I think I've found over time with just rolling the snowball, doing the work, doing the best work that I'm capable of, trying to ensure that the level of professionalism around it in terms of very clear publication dates and times. Again, everything's totally aligned with this is a real business. This is a professional product. This is not some fly by night thing. Just doing that over and over again, I think kind of snowballs on itself and tends to move the business in the right direction over time. But yeah, it's a lot of work and really like the branding and getting the name out stuff is the most difficult.
Yeah. And it's taking you away from the stuff that you love to do, which makes it even harder because it's perpetually on the back burner for the stuff that you want to do and feel your best at.
Absolutely. So, it's outside of, really outside of the book and podcasts and other things like that, there really hasn't been much that seems to have kind of worked. Again, outside of just doing the work and trying to build the email list but social media and things like that they're just not particularly helpful. So it's a continuing challenge.
What do you say to anyone, whether investment business or not, but thinking about either going on their own, taking a leap from stability, in a corporate or a larger cocoon, to go on their own or to go with a smaller team and, do it with confidence or to do it in a way that works for them?
Yeah, I'd say, well, one, take an honest look at where you are in life, and by you, I mean your family. For me, when I started this business, I wasn't married and I didn't have a kid, and now I'm married and have a kid. And if I was making the decision today instead of 4 years ago, that would have been a different decision. There's a lot of things around. Sounds kind of silly, but things like figuring out healthcare and figuring out your tax situation's a lot different when you're not, a W-2 employee versus doing something on. So there's hurdles like that, which, like you were saying before, those are just things outside of the scope of why I did this, right? Like I wanted to do the research and the writing, and these are other things that have to be done that take time and that are not in my wheelhouse. So you kind of have to deal with those things as well. And, to the extent that your business is anything like mine, you also have the reality of, you go from a W-2 job where you're pretty sure that you're going to be paid your salary any given week, month, year, to something where you wake up each day and your quote unquote income for that year can be 2, 3, 5% higher or lower than it kind of looked like it was going to be yesterday. Mm-hmm. And when you're in my position and you're writing kind of like long-term investment research and you don't want that to influence the way that you think and act too much, like, there's a challenge there that you kind of need to be really thoughtful about in terms of how you navigate those things, whether it's not checking those numbers that frequently or, kind of just keeping your head down and doing the work. But those are the kind of the main things that come up to me. You're going to you're going to go through a starting period where 9 times out of 10, like it's going to be a slog just to kind of get anywhere close to probably what you were earning before in terms of your take home pay. So just be realistic in terms of what you're getting into, and to the extent that you can, potentially do it as a side gig at the start or find a way to bridge that divide a little bit more gracefully, maybe consider doing that as well.
I liked how you said, though, and another guest had said something similar in the episode before this, Kahi, where it was like, I can do this for 18 months. Like I know that the math works for 18 months. Anything after that, like we'll figure it out as it comes, versus viewing it. I think a lot of times I'll hear people view it through like, this is a forever decision that will impact me forever. And that is just so overwhelming. Whereas if you can shorten the time horizon and just be like, I can do 18 months, or I can do a year, whatever it is, that just makes it more digestible. And I think removes some of that fear that most people have, and they have for the right reasons.
Yeah, for sure. And as you get it rolling, you have to relearn kind of work-life balance, right? Like if you're someone who's going to be highly motivated for the thing to be successful and you're starting from zero, you're going to want to put a lot of time and effort and attention on this thing, particularly in the early days. And the early days go from the first week to the first 4 years pretty quick.
Yes.
It kind of rolls onto itself. And so you have to kind of learn like a new way of navigating that. And, the other thing that I had to learn early on was kind of setting realistic expectations for customers in terms of output. I was originally doing write-ups every Monday and every Thursday. So call it 2 a week. And the nature of what I'm writing, particularly when it's not like updates on companies, it quickly became apparent, like this is too much. This is overload in terms of me producing high quality output. And I have a strong sense that it's probably too much for people to read too. So it lasted, a couple months before I had to go back to readers and say, listen, I'm going to go to every Monday and every other Thursday so I can actually like do as good of a job as I need to for this to be a valuable product for you. Well, and the response was overwhelmingly positive, but like, so these are some of the things that you have to kind of learn how to navigate, and be flexible, basically, is what I'm saying, as you get off the ground, to ensure that you're creating something that actually works for you, but also that is, the kind of the best product for your customers as well.
Yeah. I was just going to say that it's hard, even if it's more valuable, right? It's hard to say it's going to perceive to be that I'm doing less.
Yeah.
And so that's the hard part. But two, like realistically, you're a long-term buy and hold investor. Like things don't change that much between Monday and Thursday that often.
Hopefully not.
Yeah. Yeah. Right. Although lately Mondays to Thursdays have been like dog years.
Yeah. For sure. But some of that is the, again, like the communication and the positioning, and this gets to like pricing and stuff too. And like what actually is the thing. And you can, you're spending all your time on something, whereas somebody else is seeing it for 5 minutes, or they're just kind of glancing at it for the first time, and their perception of it is going to be very different than maybe your idea of what it is. And that's influenced by, again, the quantity of the output, the price point, like all these things matter. So point being, like those, you got to be really, really thoughtful about how you do things. And some of it is kind of just test and learn. But, again, like it has to be, I purposely wanted to be very clear that this is not, to say something's like a Substack thing could be used in like a derogatory way in some sense. Like it's very cheap. It's going to be $10 a month,
right? Like
that type of framing. And Substack's just the platform, but that's where I operate from. But I wanted to be kind of very clear from the jump that this shouldn't be viewed in that same category. You're paying for a very serious, like something that's going to be consistently produced, same time every week, yada, yada, yada. So you have to kind of work hard to clearly signal that to people.
Yeah. Yeah. That's a challenge. To your point too, like you said it about the marketing piece, like people aren't paying attention. Like we think everyone's paying attention to what we're doing, and they're not. They're focused on themselves. So like that, It's just such an uphill battle to define yourself And never mind market it. Just define yourself so they know what to think of when they think of Alex Morris or Mike Cadaro. Like, that takes so much time.
Yeah. I mean, it's true in everything, right? I'm sure a lot of people look from the outside and go, a financial advisor is a financial advisor is a financial advisor. It's like, that is very not true. And how you show that and make it clear to people can be really, I think it's clear to people who work with you for 5 or 10 years, but it's really hard for someone who's, considering a new financial professional to work with. Like, it's harder to show that to them, and it's incredibly important. And that's one of the kind of continuing challenges of how to frame it and how to get that across to people.
Yeah, definitely. One thing we've done to shift gears a little bit towards your approach, towards the book itself, I think like Alliance, something that's been in our DNA. I sent you like our foundations, and like a lot of it is, it's filtering, right? It's filtering for peace of mind and decision making. If I had to like kind of put it as simple as possible, where like macro, short-term volatility, interest rate policy, like all of these things that you're reading about, it often doesn't impact sort of how you're sitting there with your portfolio position day to day, but it feels like it does because it's so noisy out there. And I think that's something like Warren and Charlie really helped distill for me, which is like, I think I just wanted to read everything and know everything in the first few years of my career. And if I read every piece of research and all the, the macro guys, and I put it all together, like some answer would spit out in my head on the other end. And it was actually more confusing. So talk about, for our listeners, how you think about some of these variables, these, this noise, and how do you block it out, or how do you weigh it?
I love the way that you just framed it, because it's very similar to kind of my evolution over time and the way I think about things. And, it reminds me of, it's a funny part of the, quote unquote professional investors. It's, I pour through all this data, do all this research, and then you got some guy who, used Netflix in 2012. And he's just like, hey, this is so much better than anything else. Like, I'm just going to buy some shares in the company, and why would I sell it? It's so much better than anything else. And you got professionals saying, well, no, look, the valuation multiple is at a 5-year high relative to its, they're doing all these other things. And, point being, like, I want to be a long-term owner of businesses with some appreciation for what's implied by valuations, but I don't want that second part to overwhelm the first part. So that requires, again, like a gray area in terms of how to navigate that. And it's influenced by opportunity costs and what else is out there, and how I can construct a kind of reasonably diversified but still concentrated portfolio. But again, it's coming back to that first part and always remembering, like, I want to be partnered with people that I think are good managers going after attractive long-term opportunities in high quality businesses. And anything that I consider as it relates to, GDP revisions or jobs report or any of that stuff, it all comes back to the filter of, okay, what does that actually mean for this? And then even like, let's say something like tariffs, like I own Dollar Tree, is a pretty sizable position for me, a relatively new one. There are going to be certain situations where businesses are meaningfully impacted by a kind of a one-off thing, or something that may be, longer lasting. Even then, I still come back to, like, okay, basically what percentage of the portfolio does this impact? Like, how much concern do I need to have about this one-off thing? If it impacts half of the portfolio in a potentially meaningful way, then obviously I need to have a much better understanding of what it is and how long it's going to last, versus if it's going to impact 5 or 10% of the portfolio, particularly if there's other parts of the portfolio that may see a benefit from something, right? And if you're like reasonably diversified, even with 10, 15, 20 names, I think a lot of that stuff really ends up being a wash. And the other problem is that so much of it is not predictable in terms of the severity or kind of like the duration of the impact. So you can't really do much with the information anyways. So I just typically kind of come back to, don't focus on those things too much. also don't, and this is something I definitely did as a younger investor, don't take everything I just said as a reason to then aggressively buy into those names just because they're trading. Like be respectful of kind of what the risk is and how long it may be for, and maybe at times just accept like, hey, it's down 5%. That's okay. You don't have to use every small move in either direction as a reason to make a decision. To get back to what I said before on the portfolio kind of morphing to a place that you don't want it to go. So that's kind of how I generally think about it. And it is to what you said before. Like, I want to be very well informed, but I always love this one example from, his name's James Montier. He used to work at GMO, which is kind of a research shop. And he talked about, they had a computer analyst or like a PC analyst who could take apart a computer and knew every single piece that was it. And he's an equities analyst, a stock analyst. He could take it apart and he knew every single piece in there and what it's for and what it did. And he just kind of made the point, like, that's impressive, but it's not really relevant at all to actually analyzing the company in this industry. Yeah. And that's kind of the same in my mind for a lot of these things. Like, to the extent that they're meaningful information and they're going to be very important and you can have some sense for what they mean over time, maybe adjust your thought process accordingly. But 99 times out of 100 for me, these things they're just things that are passing in the night, basically.
Yep. Couldn't agree more. So I mentioned it before, like when I was coming up in the industry on the sales and trading side, like the Buffett and Munger were kind of just like these two dudes who were full of old cliches that you saw and like, quotes with like a picture on them, right? Like, yeah. And I went to another firm, Brown Brothers Harriman, who was, more of this style, and it spoke to me immediately. Like, I remember driving on our way home from a vacation, and like I had, a video of the meeting on YouTube with Warren and Charlie just kind of riffing, and it helped me, I think, understand the world through a different lens. Whether it be incentives, whether it be markets, whether it be relationships and honesty, and like a lot of the stuff that's sort of passe or sort of cheesy. But what do you think? Like, I feel like a lot of people view it that way before they dive in to their work or their writings or their things they've spoken about. So what do most people get wrong about Warren and Charlie in your mind?
Yeah, I mean, I think what you said kind of frames it really well. I think to the extent that people view it as the conversations being overwhelmingly focused on like stock selection or like, magic formula type stuff in terms of this is how you invest. Like, that's not really what it is at all. Yeah. It's so much more about, thinking about incentives and so much stuff that's applicable again to just like business operation and less so the investing or like the valuation part of the equation, which I think a lot of people who get into the game, especially value investors, like kind of overdose on that stuff.
Yeah, 100%.
They become really focused on the numbers and what's this thing's multiple relative to the other thing's multiple, and what does that mean for how I should position this, security. It's part of it, but it's so much more about thinking about businesses as long-term thinking about stocks as long-term ownership in a business, right? And what does it mean to actually own a business, and why does it matter how managers are incentivized, and, just all these different discussions that are, I think, so much more applicable and useful for an individual investor in a way that greatly closes the gap between what their realistic performance is as an investor over time relative to a professional. It vastly closes the gap between the two to the extent that they grasp just the basic understanding of what Charlie and Warren are truly saying. And again, a huge and important part is accepting the limitations of what's involved in terms of accepting market volatility and knowing that you're not going to get out at the top and back in at the bottom. Like, even learning those things is so important to a thoughtful approach to investments over the long term. But Warren and Charlie give all the kind of underlying input that's necessary in a way that's very clear and understandable for just about anybody to be a reasonably good investor for a very long time, which, as you and I both know in this game, being a reasonably good investor for a long time is going to put you in a place where you're going to shake out a lot better than a large percentage of people who are also playing the game, some of whom spend all their time doing it and view themselves as, professional.
And I think what's interesting too is like another misconception I had was like they were stock pickers, right? Like, no, these guys are business owners. And I think in a world where private equity continues to play a larger role for whether it's our clients who are business owners or young people coming out choosing career paths, sort of that 3 to 5 year window and the exit and what's the multiple and all of that. Like it really is refreshing to go back to some of these principles, not just in the public markets, but just in the private markets and running and operating, businesses on Main Street.
Yeah, there's so many, again, like to bring it back to what you just said, like there's so many interesting examples of things they've done over time that I think if people really internalize the actions, it would really put a different light to who Warren and Charlie are and how they invest. I mean, the most prominent example in my mind is Coca-Cola, where they started buying the stock in 88 and 89. They bought their last shares in the company in 1994. And at one point it was more than 30% of their equity book. So this isn't some immaterial position. It was by far their largest holding. And a lot's happened at Coca-Cola over time. And obviously the stock price it's been up, it's been down, it's been left, it's been right. And from 1994 to today, Warren Buffett has never bought or sold a single share of Coca-Cola. And so that, again, like forget about if it's the right decision, if he should have done something, just think about what it means to actually do that over a very long period of time and what it truly means to have kind of like an owner's mindset in public equities. And then look around and see how many people operate similarly, even on positions that are 2% of their portfolio, let alone something that was 30% at one point. And then also relay the fact that, hey, this guy's pretty good at investing. He's had a good track record over time. He has some idea what he's doing. You probably should look at most of his decisions and go, there's some thought process and logic to this. Why did he operate in this fashion? I think that really just starts pointing you in the right direction of like, how can I play this game in a way that's sensible and that's going to work well? And if you look at the way Warren's acted, particularly on the big decisions that actually matter, I think you'll see a certain way of investing that, again, is very different from kind of what's put out there as the way to do things, generally speaking, in like the modern day.
Yeah. And that was another thing that really, I always got a kick out of, but seeing it, as many times as I did going through your book of especially Munger, like he lets academia have it all the time. And they both do, but Munger's just more savage about it. And
yeah,
I could honestly say, if you read all the annual letters and you went through this book, I would have learned more out of business than I did between both my undergraduate degree and my master's degree. And a lot of people don't want to maybe admit that, but I mean, it's so true because so much of it is just this theoretical, here's the formula, memorize it, put it on the paper, get your grade and move on. And it does not apply at all.
Absolutely. Yes. You don't have to buy the book if you want, you should, but if anybody wants a business and investing education, they will get that from either listening to the annual meetings, reading this book, reading the letters, doing all three. That will be more valuable than any. I have an MBA as well. This is more valuable than the MBA that I have.
Yeah.
In terms of just purely the business and investment wisdom.
Did you ever get into Howard Marks along the same lines? Because I think like what I'd layer on to that opinion, which I completely agree with, is like his like this successful, I don't know if he's a billionaire or not, but has all the money in the world, has a track record, whatever. and how every letter is, I don't know what's going to happen. I don't know what's going to happen next. And it doesn't really matter, because if you understand the general principles of, how the market cycle works and how psychology works, which was another thing I think Munger was great at, adding on to Warren, of like that lattice work of mental models, kind of rooted in human psychology. Like those things get you 90% of the way there.
Yeah, absolutely. Absolutely. Yeah. Mark's very, very similar in terms of kind of the learnings that come out of his memos and some things. Kind of a funny side story. And one of his, I don't think it was the most recent memo, but the one before it, he mentioned Warren in terms of Howard said something, a quote that he attributed to Warren, and then kind of put in parentheses, I reached out to Warren and he said he's never said this before. Well, it was something that he had said at the annual meetings before. So as I said before, I'm not too great at marketing, but I saw a good opportunity here. So I kind of sent it out and said, hey, here's the quote of Warren actually saying that. I mean, if even Warren can't remember the things he said at the meetings over the year, he needs this
Then we
book.
need the book.
So
we need the book.
You certainly need it. Warren can't remember it. You certainly need the book too.
Yeah. You sent it to Marks, or you sent it to Buffett?
I tweeted it. Well, Warren doesn't use his Twitter, I don't think, too often. I don't know if Howard Marks does either, but I kind of tagged him and said, hey, here's the where you were referencing this from. Warren said it at the 2000 annual meeting or whatever.
Hilarious.
Yeah. So, but yeah, Howard Marks is very, again, like to your point, a lot of I don't know, and kind of the principles that underlie the decision making. And that, again, every once in a while, something comes across your plate that looks like a fat pitch, or you can see clearly to swing at, as opposed to, you see this a lot more with people who are newer to the game, which they're learning the ropes and they're getting there. But you see things like, hey, this company trades at $132 and fair value is $144. So it's a buy. And as time goes on, you learn a bit more. You start to see kind of the fallacy in some of these ideas, particularly when expressed with that level of kind of specificity.
So what was after you finished the book, you go through it, what was your favorite part that when you go back and read it, it sort of still smacks you in the face?
Oh man. I mean, there's so many. I mean, I love the discussions around See's Candies and Coca-Cola and what that kind of taught them about, they say paying up for a good business by the valuation metrics of today. The price they paid for See's Candy was not expensive anyways, in terms of kind of the headline multiple. But in terms of their learnings on that, and the idea of, good business versus bad business, and one constantly giving you decisions that are like a cinch that they're going to work, and the other giving you one incredibly difficult decision after another. And just thinking about how these things compound over time, right? That's a section that definitely stands out. The conversation around National Indemnity, which is an insurance company inside of Berkshire, there's this period over 25 years from, call it 1980 to 2004, where the amount of written premiums looks like a roller coaster. And, Warren kind of laid it out in one of the letters and talked about it more at the meeting in terms of their decision making throughout this period being reflective of the opportunities that were available to them. But the problem is that when you run a business like this, you have a bunch of employees with their own incentives who are probably sitting at their desk thinking, if I don't write any business, I'm not going to have a job very soon. Right. So, they recognized early on that they needed to make their interest, in terms of the business owner, in terms of Warren and, Berkshire, needed to make their interest very clear in terms of, we don't want you writing business when you don't think it makes sense to write business. And they had to flow that through in terms of the incentives, i.e. nobody will get fired for a lack of volume. Yeah. We don't want you writing business for the sake of writing business. We want good business. And so it led to this kind of result over 25 years where, it was something like 60 million of premium volume to $360 million. Wow. Got a 15-year period from 360 down to 90 million or so. You call it a 75% drawdown over a 15-year period. And then an explosion again in volumes up to 600 or 700 million. And what you see is in the periods where they're writing less and less volume, they're not making a lot of money, but they're not losing a lot either. then you see periods where volumes explode and they make a ton of money because there's no supply in the market anymore. Because everybody else, as generally speaking, was writing at a more consistent level and is now finding themselves in trouble for having written business at a bad time.
Yep.
And so anyways, it's a really interesting story of Warren kind of very clearly walking through what were the actual long-term interests of the owner. How do you then align that with the interests of key stakeholders, in this case, the employees, to then have a business that, is properly run over the long term? And kind of the headline of it is the right way to run an insurance company. And, he kind of tags on. The hard thing is if you looked at this in this 25-year period, if you looked at it after 20 years and it was just a standalone company where you didn't have a very clear understanding of what they were doing, it would kind of look like a disaster in terms of the financial results. And, imagine if that's a public company and you're trying to pitch yourself to shareholders or Wall Street and kind of the incentives that you have there and how to navigate that.
Yeah, those quarterly calls would be a nightmare.
Exactly. So it's just a very clear example of Warren laying out an idea and showing kind of a case study where it's just so evident how that business is so greatly advantaged relative to any of its competitors who would be publicly owned companies in this example. And he also clearly tags on too, like, by the way, what we did here, what worked for this insurance business, it's not applicable everywhere. You can't do this with an auto OEM. You can't just shut down the line because, you're not producing at a sufficient level of gross profits per unit or something. Like, you'll go out of business doing that. So these ideas and rules have to be thoughtfully understood in terms of their applicability to different businesses and industries. So again, it's just like a full circle way of something that's kind of like common sense, but when applied in practice is really insightful kind of learning experience.
And it may not be applicable outside of insurance, but the idea of understanding how your employees are incentivized is, right? And that's where the rubber really hits the road of like, what are you incentivizing these people to do every day? And just go into the organization and really be honest about that. And most times you'll be shocked at what the unintended consequences are of these poor incentive structures that we see all over the place.
I think about it right now in terms of a company I've followed pretty closely for the last couple of years. It honestly hasn't been anywhere close to something I was going to buy. And the valuation struck me as quite expensive, but I also kind of really doubted the strategy and the management team, but is Nike, where the company they've consistently, for the better part of a decade now, been overly optimistic on kind of near term, but especially medium term kind of revenue growth targets and margin targets. And it coincided with a period where they're kind of shifting the business from wholesale, call it like Dick's Sporting Goods and Academy, Sports and Outdoors, like those kind of channels to Nike Direct, which really is their digital business more than anything else. And to make a long story short,
I remember when they pulled out of Amazon. Like that was a huge decision.
Yeah. So to make a long story short, effectively the company got out of a bunch of wholesale partners that they kind of should have been with, or at least the way that they should have been with them should have been more thoughtfully considered, which opened up the door to some emerging competitors like On and Hoka. They also leaned very aggressively into digital and started being incredibly promotional on their platform, which obviously is not really aligned with the long-term brand at Nike. I mean, they gave a very telling example on the call. The new CEO said, in January and February of this year, so called 60 days, we had 0 days of promotions on the platform. Last year in January and February, those 60 days, we had 30 days of promotional events across. So It just became like a big discounting. They were discounting a ton of product, but obviously that's reinforcing the brand image and how people think about pricing and everything all the time, right? And you can just see how over a period of years, these small decisions kind of compounded on each other and got Nike to a place where, in my mind, partly because they're chasing these unrealistic financial goals, they started making decisions in terms of how the business was run that were taking obviously a very well-known brand and a very large brand in a very dangerous direction and quickly. And my point in saying this is you just see how incentives and poorly thought out goals, in this case, growth as opposed to brand health being the primary concern. You see how that kind of compounds on itself and can take a situation that looked great, 10 years ago to something that was heading in a very bad direction as of even 6 or 12 months ago.
That's such a good example in that I've obviously heard and read a lot about Nike, but not in that framework where it comes back to the goals and it comes back to the incentives of management and everything. Yeah. All hell can break loose from that point on, right?
Yeah. And they started pushing, just real quick to add on that, they have like these classic footwear franchises that they know are kind of gold and can sell. And historically, they've been very thoughtful in terms of how much supply we put out into the marketplace at any given time. And as they now hit a period where they were kind of chasing incremental revenues, they pushed that harder and harder and harder and harder. And then they got to a place where they did exactly what they knew they couldn't have done, which is kind of oversaturated the marketplace and lost that kind of special feeling that those brands had. And again, like anybody could step back and go like, how do you manage the Nike brand over the long term? And what would you and wouldn't you want to do? That'd be pretty clear to most people if they thought about it for a short period of time. But management got to a place where they were doing kind of exactly what you wouldn't want to do because they stumbled down this road of kind of poorly thought out incentives.
Yep. So going back to your business, well, one, where can listeners or viewers find your work?
Yeah, you can go to scienceofhitting.com or TSOH Investment Research. You can find me on Twitter as well, TSOH_investing.
How has the investment research game changed with technology and just the overall barrier to the data itself being lowered so significantly and at this point maybe even exponentially with AI and the way it can be utilized?
Yeah, it's a really good question. I think there's a couple different layers to it. In terms of just broadly speaking, anybody producing investment research, obviously the ability to go out and distribute and to find customers and, for someone like myself who's not particularly technically savvy, to basically rely completely on a platform like Substack and Stripe to manage all of the, the website stuff and pushing out the content and dealing with payments. Like, obviously that's a complete game changer. Like, I couldn't have done this without those platforms. There's zero chance I'd be doing this because I would have no idea how to like cobble that stuff together. And if I had to pay somebody, it might not be, cost efficient to do so. So those have been a game changer in that regard. In terms of access to data and other things like that, it's funny. I think it depends on the game you're playing to some extent. Like if you're playing, and I've long believed this, but I think it continues to be more and more true over time. If you're playing I'm going to predict next quarter how the stock trades on the earnings release game, you're playing against people with access to a lot of very high quality information that can, in the case of like this scanner data, which for people who don't know is like the sales at a given, at grocery stores, at convenience stores, et cetera. Like they'll have weekly sales data for, in the case of like energy drinks, Celsius versus Monster versus Red. So there are people who have access to really high quality. It costs a lot of money to get that data, but they have access to that every single week. So you could probably reasonably suspect that if you don't have access to that data, trying to outguess those people on how the quarter is going to come in relative to expectations is going to be quite challenging.
Yeah.
On the other hand, if you're kind of thinking about these things in terms of a more long-term perspective, that data is certainly still relevant. What it means to your investment decisions and how it influences your thesis is, kind of a more interesting question. I think it obviously, 1 week of data may not be that relevant. A month or a quarter is more relevant. A year or two is even more relevant. So it certainly has some value and importance, but also, in those cases, in those companies, particularly energy drink companies, they also trade in terms of the stock price, they move significantly on this weekly data, which again, may or may not be that important in terms of where Monster's going to be at in 2030.
Yeah.
Or where Celsius. So there is a component of it that I think has.
But I don't think a lot of people are defining what game they're playing. Like, I really don't.
I agree. And I think that is probably one of the biggest mistakes you can make as an investor. I think defining even broadly what you're doing or trying to do, again, because as I said before, like that first action then defines the constraints that actually lead to decision making and actions. And again, I don't even necessarily agree or believe that there's like one right way to answer that first part, but I definitely believe that not having an understanding for how it informs decision making on the second part is going to lead to a difficult place.
Yeah, so that could be fatal.
Yeah, exactly. So you'll end up with as I said before, you end up with a portfolio that maybe doesn't look at all like what you were actually
setting out to accomplish. Yeah,
exactly.
So two more questions for you, because I know I've taken up a lot of your time already. So another podcast guest, a guy named Eric Markowitz, he laid out this idea to me of like, as the cost and time it takes to do research goes down, your conviction is actually more valuable than ever. Does that make sense to you? Where if everybody has access to, endless amounts of data compared to what was even available a few years ago, where is the alpha generated?
Yeah, I think it kind of gets back to the last question. I think in some ways I think it's tied to your frame of reference what you're thinking about being a bit different than the market. And that idea can go overboard, obviously. And again, like I think, weekly scanner data eventually becomes annual scanner data. And eventually it's your market share in the category relative to your competitors. And these numbers are relevant for a long-term thesis. So it's not like the information doesn't matter. It's just how it's basically being perceived and then being used. And I think, the other part of that is people can get to a place where they're really focused on, let's say in that case, just those figures that are coming out in any given week without necessarily understanding if the strategy is changing or if the way that they're interpreting the numbers should be changing. And maybe the best way to say that is an example, like I mentioned Dollar Tree before, like it's a company that's going through a very clear strategic pivot in terms of they were everything in the store for $1 effectively at one point in time. They've now moved past that to kind of like a base price point of $1.25, but they also introduced multi-price throughout the store a little bit. And in my mind, the trajectory they're going down is very similar to what a competitor in Canada named Dollarama did 10 to 15 years ago. So point being, without a frame of understanding of what their strategy actually is and where they're trying to go, I don't necessarily know that someone can just purely look at the numbers or things that can be easily quantified and understand whether or not the strategy is working. And that's where, in my mind, the conviction comes from. And it's where you get the interesting part of this game where you start with, I want to buy things as they get cheaper. And it can flip in some ways to my conviction in a story or a thesis is becoming clearer as I'm getting evidence that it's right. I need to be buying, even though the stock's up 5 or 10% from where I bought most recently. Bringing it back to the example I mentioned before, I always think this is interesting. So I said Warren bought in 88 and 99 is when he started buying Coke. He didn't buy for a couple of years, I'm pretty sure, until 94. He bought more. The shares he bought in 1994 were at a price that was almost 3 times higher than what he paid in 88 and 89. And I always think it's a fascinating number in terms of particularly value investors who are like terrified of paying 15% more than what they paid for something at any point in time previously.
Right.
And it's just interesting to think that, you have to be really thoughtful, particularly if you're long-term, what price means relative to kind of where you think value can go. So yeah, I think what the term conviction is has to be kind of defined. Some people define conviction as a price to fair value measure that's based on where they think the stock's going to be at in 12 months. Other people define it very, very differently. And, again, you have to kind of know where you are and what it then means for how you approach investment decisions.
Yeah, no, that's really good. So what did, I want to make sure I frame this the right way, given our compliance and our industry and more broadly, but they talk a lot about, like, Munger. One of Munger's lines that always stuck out to me was, you cannot do a good deal with a bad person, right? And they can come off a little bit self-righteous maybe in the way that they talk about this, but honesty, transparency, really buying the person, that's something that they always come back to when it comes to management, and then just kind of letting them do their thing. Like, if you need to sign certain legal documents when you're getting into a deal with somebody, then like maybe you shouldn't be getting into a deal with this person. I've seen you talk a lot about transparency in your work too. So talk about that through the lens of the investment world, where that, I don't want to say it's in short supply. That's probably a little unfair, but where that's increasingly important. Yeah.
To your last comment, to your point, I think short supply is probably a bit unfair. It's a challenge of an industry where you're bringing hopefully in most cases, the investment advisor we'll use as the example here is bringing a certain level of knowledge and understanding about the topic and a depth that isn't necessarily aligned with what the client is, right? And going too deep, especially down certain rabbit holes, is probably not only not helpful, it's going in the wrong direction, right? So it's like that's a challenging part of navigating that relationship. And I think fairly that then shows up in ways that could be defined as an outsider looking in, like as a lack of transparency, basically.
Yeah.
The nature of the discussions is like not real. It's not getting at the core of the matter, but it's really difficult to get at the core of the matter because it could be going down a rabbit hole.
Yeah.
So I appreciate why that's really hard. And it depends who your clients are, right? In terms of how those discussions would go. In terms of what I'm doing, I'm very clearly seeking out kind of like serious DIY investors who care about the individual security analysis and selection process, or professional investors, CIOs or analysts at funds, whatever it may be. So I know the nature of who my audience is. And I think there's something to be said for being able to kind of write to them incredibly clearly and directly in terms of, here's what I'm thinking about XYZ. Sometimes I finish pieces and go, I'm not totally sure. Or like the Nike write-ups. I've been writing about it for 3 years, and I've probably written about it 5 or 6 times now. And the general tone has been, something's kind of off here. I don't feel great about how this business is being managed. I think there's certain things about Nike that are incredibly attractive, and I could potentially own it over time, but there's a long road to go down to get there. And we're a lot closer now than we were a year or 2 ago. But so someone has to be comfortable with the output not being like, buy this now, or like short, you know what I mean? Like,
yeah,
this is actionable today. Like, again, I think a lot of it is just how it's framed and communicated, and kind of being comfortable in that transparency. And it's one beautiful thing about what you were saying before about how kind of research has changed and evolved. Like, it's one amazing thing about the internet that certainly isn't applicable just to investing. Like, you can find kind of a niche audience that is interested in what you're doing, and the size of that niche, you can build a sustainable kind of business, which means, I guess a direct example of that would be someone who's writing like a buy type of newsletter. Like, they should probably charge $19 a month or $9 a month and get 100,000 subscribers for, people who may be interested in that type of thing. But if you're not going to write that, and you have a sense that the audience is going to be 1/100th of that size, then the pricing obviously needs to be different. so it's all kind of structured in that way. Again, I think it builds credibility the same way that it does for an RIA or an investment advisor. It helps client retention. It helps build the business. It's all good in the long term, and it's kind of self-reinforcing.
It's also easier to go to work every day.
It's easier to go to work every day. Again, it does lead to times having kind of like painful conversations or things that it would be nice to just not be able to have to talk about those things sometimes, but also doing it is kind of what reinforces a point of differentiation and kind of builds the brand. So I think once you start doing it, once you're honest about those conversations, then it just becomes like second nature, and you really can't imagine doing it another way.
Yeah. So my last question for you, and maybe we could do it a little bit differently in terms of, let's do it through the lens of the book. So I've asked everybody who's been on the show this question to end it. So knowing everything you know now, sitting here today, what advice would you be giving 22-year-old Alex, leaving the University of Florida, looking to get started?
Yeah, I mean, it covers a lot of ground. I would, one thing I've heard Charlie Munger say many times, Charlie Munger went through a point in his life where, for people who don't know, he had a young child who died, and he was getting divorced at that time. And I'm not totally sure if this time period aligns, but he had a period where he was running his fund where the results were very bad for a handful of years. And it was tough for him, obviously, to have the first two things more so than the last one, but it was a difficult period. And, he kind of talks about the idea of basically never feeling sorry for yourself and keeping your head down and continuing to do the best work you can and trying to move forward. And I'd say that's a huge part of life. And you don't know where it's going to necessarily lead you, but you keep your head down and do the best work you're capable of for 5, 10, 15 years, you're going to get somewhere over time. And, you live in a day and age where you can go out and put your output of that, whatever, it could be written investment research, it could be art, whatever it may be, your output can get out there on platforms like Substack or Twitter or whatever it may be. And I think, to the extent this wasn't always true, your ability to get in front of potential employers or people who can be mentors, whatever it may be, is as great as it's ever been. And most people, especially the ones you want to work for, care a lot less about where your degree is from and care a lot more about indications of your effort and your willingness to learn and your desire to do something. So you have the opportunity in front of you more than ever. You have to put yourself out there a little bit and take the risk and accept that, the first things are not going to be very good compared to what you can do down the road, hopefully. And that's how life works. And if you played any sports or done anything like that, you've already dealt with that before previously. So it is what it is. Along those lines, I'd say be open to having optionality in your life and thinking about, again, there's definitely like alternative business models that you can pursue and, things that, were a bit more difficult to probably put into practice, again, even 10 or 20 years ago. So maybe consider some of those things as you're kind of plotting forward over time. Those would probably be the main things. I mean, work-wise, I can remember my first job out of school. I was going into finance, so I had some hopes, at least, of being well paid. And the one job offer I got was for, I think it was $27,000 a year, and I accepted that job offer because there were not any others, but it wasn't very much money. But it was a job where I basically worked with a guy who was starting an RIA business, and he said, basically get to work, like figure out what we need to do the research, do all. I was basically a secretary as well, which I didn't love that part as much, but I worked somewhere where somebody basically told me, put your head down and get to work. And that fit really well with who I am and how I could learn. So, these are things that are relevant to think about as well. Like as you're going and getting a job, like just sit back for a little bit and think, like, do I want to work in a corporation? Do I want to work in a small firm with 15 people? Like those are decisions those are probably the more important decisions than like, what is my comp in year one?
Yeah.
20% higher
100%.
or lower, that shouldn't be the thing that kind of drives your decision.
Yeah. No, that's really good. And I think it applies well past the age of 22.
Yeah.
So,
yeah.
Alex, thank you very much. Alex's book, again, it's Buffett and Munger Unscripted. It'll be sitting on my desk and has been over the last few weeks. So thank you for spending the time with us, and look forward to continuing this conversation down the road.
Yeah, it was a great discussion. Thank you so much.
The information in this interview is provided for informational purposes only and should not be taken as investment, legal, or tax advice. Opinions expressed in this interview are subject to change without notice. It is important to remember that investments in securities involve risk, including the potential loss of principal invested. Past performance is no guarantee of future results, and diversification does not guarantee a profit or protect against loss in a declining financial market. Alliance Wealth Advisors is an investment advisory firm that is independently owned and operated. Alliance does not make any representations as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by an unaffiliated third party mentioned in this communication and takes no responsibility. Our guest did not receive any compensation for this interview, is not affiliated, and not a client of Alliance Wealth Advisors at the time of this publication. For more information regarding Alliance, please visit alliancewealthadvisors.com/legal disclosures.